Well, hello, welcome back to my channel. It's been about a month since I made the last video. If you haven't checked that video, make sure you go check it out. It's about how you're losing money without knowing. I think it's because you probably lost money since then. But I do think there's a bet you should go and check it out. And make sure you like and subscribe. So, investing is a very important thing to me, and I do think for normal people, investing is something they need to look into to gain returns for that money. Because if you don't know, you're losing money without you doing anything. And I have a video about that, and please make sure you go check it, drop a like, subscribe. But to really invest, you have to know the number one rule in investing, which is do not lose money. And how you do this is really about education and understanding the company you want to invest in. This is if you're investing in an individual company, and you really need to know what you're doing to make sure you don't lose money. Because if you want to invest to make sure you don't lose money, it doesn't mean that you're free from the risk in the stock market. Because again, the more risk you take, the more returns. But again, it means that you are taking risk in the stock market, and there's no way to really ensure yourself from not losing money. But you can reduce that risk by really understanding what you're putting your money into. And this is why it's important to understand that you are a business owner and not just a speculator if you really want to invest for the long term. So there are three different statements I think are very important, which is why I call the fundamentals in understanding a company, at least for us. Because we're not inside there, we need something to at least make us understand what they're really doing. And this is really, most of this information, or all of this information, is what is in the 10K, which is a document every public company is required to put out to tell investors about their company. But these 10Ks could be around 400 pages long. So as investors, as retail investors like us, we don't really have a lot of time. So we need to be able to find out the different things we need to pick out. And there's three different statements. So there's a balance sheet, there's an income statement, and then the cash flow statement. All of this work together in a tandem, but they all say different things about the company. And there's also other research you need to do. You also need to do how they're making money, who are their customers, how is the industry they're doing. But there's three different statements that at least tell us how well the company is doing financially. And today we're going to talk about cash, because at least in the accounting and finance world, they say cash is king, because cash is so important that you run everything through cash. Without cash, there's really no business. And it's so important that there's a statement all about how they use cash. And that's what we're going to talk about today. Today we're going to talk about cash flow statements. What it just says is, how are they spending that cash and where are they getting that cash from? Because if you're putting $10 into something, again, $11 back, that's a 10% return. So you're using your cash properly there. But if you're getting negative, if you're getting $9 for every $10 you spend, you're probably not using your cash properly. And as investors, we're forward looking. So we want to know, what are you putting your money into that you will get more cash in the future? And there's three different parts of the cash flow statement. There's the operating cash flow statement, there's the investing cash flow statement, and there's the financing cash flow statement. Well, financing activities, investing activities, operating activities. All of these are in the cash flow statement. And they say different things. So the operating cash flow, I think is the most important one. So the operating cash flow talks about your operations. Your operations. This is the day-to-day inner workings of the company. So it literally just tells us if they put $10 into the company, how much money do they get back? This is why we want to see a positive number when it comes to operating cash flow, because it means that we are now putting money into something that cannot generate that amount of money and more for itself. This is why operating cash flow is very important, because this is the bread and butter of the company. And alright, so if you made it to this part of the video, I don't know how long this is already in the video, but just make sure you drop a like and subscribe, because I know I have to remind people to do that, because I myself don't like videos unless the guy says to. So make sure you drop a like and subscribe, because this, I need it at the company. And one thing that's very important to know is that if you see a negative number in cash flow in statement anywhere, it means that they spent money. If you see a positive number, they draw money or they're able to get a return of cash. So this is why when you see if a company takes on debt, it's a bit positive. If they pay off debt, it's a bit negative. And I think that's a very important thing to know. And negatives and positives are not always good as you conventionally think when it comes to the cash flow statement. So what we want to know is that the operating cash flow is positive. I think that's the most simple part, and that's for every company you want to put your money into, you want to know that the operations can sustain itself and get more money to invest in its own self. So now the second one is what we call investing cash flow. Just like us, that we want to invest into different things, maybe it could be real estate, but today we're going to talk about stocks and bonds and stuff like that. You want to be able to make sure you get benefits from that from the future. This is why a lot of the times we see negatives in investing, because they're using their cash to buy stuff like plants, property, and equipment, or stocks, or derivatives, complex financial instruments. Which is what you see companies doing in the investing activities, because they want to see financial benefits later in the future through their spending their cash. So most of the times you see it as negative. And sometimes, depending on the company, if I see that number as negative growing, if the negative is growing, I can see that I'm investing in a business, depending on what they're doing. And you can also, in the investing activities, you can also see if they sell a part of their business or buy another part of a business. And it's mostly positive if they sell these investments. So they've liquidated investments to get cash. And that could be a bad sign that they can't get enough cash from their actual operations, that they have to sell, their plans or a business to get cash. So those are the kind of things you need to understand if you're investing and you really want to understand your company. And then the next thing is the financing. So financing cash flow is all about external people. So we know that operating is internal, external is financing. Financing activities is your relations with common stockholders, like people like me, and banks and financial institutions. So what we see a lot of times is debt, repayment of debt, dividends, and repurchasing of stocks. Those are the three biggest things in the financing activities. So they don't have anything to do with the actual day-to-day running of the business, but it does show if you get money from outside and how much money you're getting from it. So let's just say you had a public, you just went public now and you sold your stock for an amount of cash. That amount of cash you get from outside investors will show up as a positive in financial activities cash flow. If you take on debt, like I said before, you will get a positive number. And it's very important to understand this, because when you see negative numbers in financing, it's very important to understand what they're doing. So when they pay out dividends to people like me and you, when we invest in a company, it means it should be shown as a negative, but it's a positive thing if they pay dividends in most scenarios. It can also be when they repurchase their own stock, which means that they reduce the amount of stock outside so that each stock becomes more valuable and the company becomes more valuable in return. It doesn't always work out like that, and I as an investor don't really like that, because I think it's a waste of money, because you're not putting that money back into your business. But that's the way they may decide that that's the best thing they have to do with that cash. And repaying of debt. As an investor, I don't really like too much debt in the company's books. So when I see that they're taking on debt and the numbers keeps coming on positive, and it's going to really hamper their activities in the future, because they're going to have to worry about paying off the debt instead of improving their product or getting more customers or building a plant or something like that. So that is what the financing activities have to do. It's all about how are they getting money from investors and banks, and how they're paying off their debts, and how are they paying dividends or repurchasing their own stock. That's basically what the financial activities is. It's not really the operations. And everything comes into what we like to call the free cash flow statement. As the name means, it's the money they can use to do anything. And it's basically a simple calculation. It's the amount from operating minus the amount you spend on capital expenditure. So we can just think of them as plants, property, and equipment. Because, I guess the rationale is that this is just an expense you have to do. So the free cash flow is what they can use to either put back into the business, pay dividends with, or repurchase stock. So this is a very important number because this is the real profit of the business. I mean, maybe the operating activities profit is the real profit of the business, but free cash flow is the money they have left after everything. This is the amount of cash they actually have to really play with, to invest with, or to give back to their shareholders. And I think this is the most important reason why the cash flow statement is necessary for investors. Because if people don't know this, the profits are an accounting product. I mean, the profits tell us something, but at the same time they tell us the best the company can do, the best thing the company can manufacture from what they've done for the year. So because there's a lot of different things like depreciation, they can speed up depreciation if it's granted by the law. They can get tax refunds which can go into gains. Foreign currency translations can bring a magical gain. So the cash flow really tells us the nitty-gritty and simply how much cash is left. And I think this is the most important reason why we need to check the cash flow statement, because it tells us something different from the revenues, profits, and balance sheets. It really tells us how is the company making money, and for every dollar they spend, how much cash are they getting back. So if you like this video, make sure you like and subscribe. This has been in one take, so make sure you like and subscribe. Thank you again. Make sure you watch all the other videos. We'll be back next time to at least tell you one stock I have made good returns in, and how I came to that decision to buy that stock. So I think this would be a good example of how to go about investing. I'm not an expert or anything like that, but I do want to show how I came to the rationale to spend money on a stock where I thought would go up, and in the last day it has made an incredible return. So make sure you drop a like and subscribe. Be ready for next time when I show you that stock. But remember, past returns don't mean future returns. Thank you.